This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. My guest today is Amy Cook. Amy is a financial planner and advisor, and she works for Maven Financial Group out of San Mateo, California. Amy, welcome to the show.
Thank you. I'm happy to be here and excited to talk to you today.
Amy, you are a best-selling author. Your book is called Your Money Narratives. Tell us, what are money narratives?
So money narratives are really just the kind of the stories we bring to our adult life that could have, been from when we were little, or as we grow older, we may accumulate more narratives. And typically there's situations or things that we're taught that we just kind of carry on through life and base a lot of our decisions and, for the purpose of the book, financial related decisions based on these stories.
It sounds like a lot of these narratives are kind of subconscious, right? Like we don't really think about them. That's just how we were raised, or that's how we kind of pick things up when we were growing up. Do you have any such narratives that you never really thought much about? And when you were older, you were like, hey, you know what? I've been thinking about this my whole life, but maybe I'm thinking about it the wrong way.
Well, absolutely. I think that that's kind of, as my career evolved in this business, I started thinking about my own narratives and what I was carrying through into this business and listening to other people's stories. And that's where it all started. And as a kid, I had a couple of narratives that formed early on around money and the lack of and needing more and what I attached those things to. And so as I started to learn about my own money narratives, I started noticing them, just in general with my clients and just other people that I talk to.
So tell us a little bit more about the typical clients you have. And I ask because you are located in San Mateo, and that is almost or more or less right in the heart of Silicon Valley. And Silicon Valley is known for having a lot of people with very high incomes, very sort of unusual lifestyles. What is the typical client you have?
So, I mean, it depends on the advisor, what the typical client will be. I mean, my clients, I like to say, are just normal, they're normal people, but I guess, that depends on who you ask. But I do work with a lot of, tech people and employees and business owners and retired couples and a lot of people who just really did have kind of regular jobs and may have stayed in that same position their whole career and, retired with a pension or whatnot. And they're just trying to make sure that they're going to have enough and that they have everything in order as well as they can. And, for the most part, from people that don't have as much or people that have a lot, people don't want to run out. We want to make sure that we have enough. We're not going to run out. We can do the things we want to do in retirement. And that's where I kind of help step in and help to be sort of an aid or a partner in the journey there.
And let's say a client comes in and they're in their late 20s, early 30s, and they're very fortunate. They have one of these high-tech jobs that we always hear about where they're earning deep into the six figures. What are some of the things they may be overlooking, right? Because it's very easy for someone to think, hey, you know what? I have a great job. I'm saving some money every year. I got this. I max out my 401ks. On top of that, I got this really healthy company match. And maybe I don't need to think about money. Like, what are some of the things they could be overlooking?
Oh, so there's a lot of things. First of all, I love it when I get to talk to people that are in their 20s and are looking at hiring a financial planner advisor. But a lot of times, when people get those types of jobs, they get a lot of stock. And it's a good problem to have, but there's a lot that goes into managing that. And sometimes, there's a lot of mistakes that can be made if you don't manage it the right way. And what can also happen is you become really heavily weighted in this one company if you just do nothing. So you're getting these RSUs or options or whatever every year, and then you're letting them vest, sit, pay the taxes, whatever, and they're just growing. And so here then you have a substantial amount of your net worth, you have your paycheck coming from the same company, and it can become really out of line, and you're taking on an additional risk this company specific risk that you don't, realize that you're taking on. And so that's one of the main things that seems to happen a lot.
On that topic, what is your threshold for too much? Like, let's say hypothetically, somebody works for a company like Facebook, and like I said, 20-30% of their net worth is in Facebook stocks or stock options, and their entire salary comes from Facebook. What percent of their net worth do you think we should be like, oh, you know what, that's a bit too much. Maybe you should sell some of that Facebook stock and invest somewhere else?
Yeah, so that's a good question. And sometimes the too much is unavoidable depending on where you're at. I mean, if you're just getting started and you don't have any other investments, then it's going to be 100%, and that's too much. If the positions haven't vested, there's not really a lot that you can do there. But as they do, diversifying is a good idea. If I'm looking at just a single position, I would say, 10%, or, keeping that balance. But when you've got those company positions like that, you're always vested. I mean, that's how they keep you there, right? So they're always adding to it. And so there's these varying levels of positions that, oftentimes it's going to be a bit overweighted, but sometimes, like, if you do nothing and you're there for, 15, 20 years, I mean, you could have a substantial net worth and have 80% tied into this one company, and that's heavily overweighted.
When you have clients who talk to you about early retirement, right? And by early, I mean, say, well before the 59 and a half, where 401ks and IRAs become accessible. Let's say somebody wants to retire at age 50. What should they be doing differently than somebody who says, I love my job and I want to work as long as possible? I'm going to be working until I'm 65, 70 because I love my job. How should those two people look at their investments differently?
Well, I mean, there's different considerations, right? If you're going to retire early, then there's going to be a gap typically with things like healthcare. So there's additional pieces that you'll need to solve in the interim, between, retirement and getting to Medicare. And then you could have, kids that are in college. And so you have to just really, every situation is so different, and look at what it is that you're trying to accomplish. What does it look like for you? Because I could want to retire, at 50 and go travel 80% of the year. You could want to retire at 50 and, hole up with like a hobby that doesn't really cost a lot of money to keep going. So it's hard to put those blanket kind of, prescriptions onto things when everyone is just so different in what they want and what they're trying to accomplish. And that's what makes financial planning just fun, really, because everybody's different.
And maybe what I was trying to get at with that question was, if someone wants to work until they're 65, 70, it's easy to tell them just put your money in 401ks. Whereas if someone wants to retire at 50, then you're like, oh, well, those 401ks, it's going to be very costly to access them
Got it.
before you're like 59 and a half. So would you advise them to start investing in real estate or like in some oil syndication, or start, doing something on the side? Where would you advise them? How would you advise them differently when it comes to investing?
Well, I mean, from a basic standpoint to what you're saying, yeah, you wouldn't be able to pull from those other types of accounts. So you would have to ensure that you had assets in non-retirement type of vehicles, tax advantaged vehicles that you could pull from to bridge the gap. And so that's kind of where the income strategy comes into play of what are we going to pull from to solve, for these years? And you'll have different buckets, which obviously can change because life changes and plans change. And you might retire and then decide to go back to work the next year. So on a year by year basis, you're projecting and you're looking at, okay, what is the best route for this year? But if you're gonna step out early, yes, you're gonna have to have other pieces to pull from to other than just a retirement account to get you there. And you're probably gonna have to save a lot more too than what you could put into a retirement account to bridge that gap, because now we're solving for, 40 to 50 years versus, 30 years.
Focusing on the Bay Area specifically for a moment, I know a lot of people outside of the Bay Area, they often have a lot of assumptions about, oh, the people in the Bay Area, they have very high salaries, they make a ton of money, they probably don't have all kinds of problems and difficulties with money. But when you think about your clients specifically here in the Bay Area, what are some of the challenges they have that might be unique to this area? And what are some of the things they're overlooking?
Well, I think one of the things that happens in this area, which, other people would say, oh, it's a great problem to have, is that so much of their net worth, if they've lived in a home for a long time, is in their primary residence, which it's not considered liquid or assets that we can really use. I mean, if I put together a financial plan, that's going to be just static, even though it may grow and it will increase your net worth, it's not necessarily money that we can pull from. So a lot of times, that becomes overweighted too with the real estate position here, which then ends, in turn, a lot of people end up selling their homes, moving to other states. And I know that, a lot of other states aren't happy about that, but we take the big cash out and then go pay cash for a house somewhere else. And there's a lot of people that are doing that.
Getting back to the narratives for a moment, what are some of the narratives that have a negative outcome? What are some of the narratives that when one of your clients has these assumptions and they start talking to you about them, your red flags go up and say, you know what, like this is the 10th time I'm hearing it and it's a misconception, and let me clarify that.
That's a good question. I think that, a lot of times we have fear. Fear is sort of the wrapper around things where, if I invest, I might lose all of my money. So I'll see, people that just have their money in cash because they might have experienced something with, their parents buying a bunch of penny stock or something and losing it all. And so they've got this feeling that if they do that, that could happen. In my case, my parents lost our family home when I was really little. So I had this security fear, and that it also attached to money and needing to make sure that I had enough money so that didn't happen. But then also this fear of losing the house, because there's this, kind of feeling that we were just being, we were basically being pulled away from the house and losing that security blanket. So there's so many, or, you get some of the older generation who have more money than they'll ever be able to spend, and they will be afraid to spend any money to buy a new washer and dryer, or they feel guilty about spending money or buying anything. And so I just think there's a balance, and sometimes we have to just kind of look at some of the stories and say, does that really make sense? Because I see, it seems to be working here, and here, Joe and Mary, and is that something I need to look at? And really, that's all we can do, is just start to question some of these immediate responses to things that we might have.
I feel like everyone is looking for that one magic investment that's going to beat the stock market every single year, will never go down. You will never, ever lose money. It's guaranteed not to lose money. If you lose money, somebody compensates you. I mean, that doesn't exist, right? But how do you have that risk reward conversation with your clients?
Balance. It's having what you have in different things, and the diversification of not, being all in over here, all in over there. I mean, we're not in Vegas, and it's a slow process. Dave Ramsey talks about this a lot, the tortoise and the hare analogy, which I love, because it's like you jump in and you want everything to happen overnight. I think that's it's a terrible way to approach it, because it's really a build, and you start to notice the growth and the reward over time. And you don't have to just get everything done at once. It doesn't all have to happen overnight. Even if I put together a laundry list of action items for someone that I'm working with, it doesn't mean that they have to run out and implement everything the next day. But we sort of just like check a few off, and then get together. Oh, those are still okay. We're going to check that one off. We're going to check that one off. So it's a process. And then life changes. So then you get things done and you go, oh, well, I thought I was going to be at this job for the rest of my life, or I thought I was going to be in this house, or I never planned to get married, or I never planned to have kids. And, and then life changes. And then you have to change, you change the plan.
What is your thesis on diversification? You mentioned it about a minute ago, but I'm really curious.
I mean, I don't really have like some set formula that I can lay out for you. I mean, but I do think that, there's a lot of good things. And it's so if you have all your money in real estate's great. But you need to have liquidity elsewhere to support things that could come up with that. You've just got to protect yourself. So there's this balance of having insurance where you need to have insurance, the real estate piece, the investments, the type of investments. And so the percentage, like it's not like 10, 15, I mean, there are some variances within that, but you want to have your overall portfolio in different places.
When you say different places, do you mean different asset classes or just different mutual funds or different stocks?
Well, different types of investments. I mean, so it could be your real estate, it could be your retirement accounts, it could be, the different asset classes within those retirement accounts. So we have the buckets, and then inside of the buckets, we have, the types of investments that we can put inside to diversify even further.
So it doesn't sound like you tell your clients, hey, look, you need to be this many percent precious metals, this many percent, domestic stocks, this many percent real estate. You don't have a set formula. You're just more work individually with each client.
Well, no, within investment models, yeah, of course I have formulas there, but as far as if someone has a focus where they really love to invest in real estate, there may be one person who wants to own investment properties and another person who does not. So that's why, it really comes down to, I think that there's different ways to accomplish goals. I don't think it's just this black and white, model that everybody has to be in exactly the same thing, but it really comes down to what do you want? I mean, if your goal is to create a certain amount of income in a certain way, then I'm here to help people kind of put together plans to do that.
How often do you meet with your clients? And in your experience, how many meetings do you need with a new client before you really understand them and you really have a good feeling of what they're looking for?
So I meet annually with I have annual meetings with all of my clients. As far as at the start, I mean, it really depends because some new clients they may be getting started and they don't have as much going on, and not everyone is looking to jump in and engage in like a comprehensive planning. Some people may want to they have a very specific concern or a specific account or a specific situation. And then other people are like, I just want to know where I stand as a whole, which I personally love that because I think looking at the whole picture and how each different component affects each other is a great way to start, which is really the basis of financial planning. But it really just depends.
Amy, tell us about your book. I'm really curious. Tell us a little bit about what people can learn from the book, your money narrative, and also a little bit about the process of how you ended up writing the book and the whole publishing journey and the whole story behind it.
Yeah, so the book is so I've worked with so many clients over the years, and I have about 250 households now that I work with. And what I've noticed is that a lot of my clients, they don't want to go into the weeds with all of the technical analysis on every little thing. They just, want to understand it. Like, what does it look like? Shoot it in basic terms so that, understand what's going on. And so I found that, a lot of other people overcomplicate it. So I don't see any reason for that. And I also think that people can relate to stories. And so the approach for the book was really just to kind of take no one's story specifically of anyone that I've worked with, because they're all just sort of like a meld of different stories, but different topics that come up a lot. And they're basically a bunch of short stories and then some ideas after the short story of what they could consider in their situation. So what I've heard and what I was hoping for in the feedback is that it's an easy to read financial book for a lot of people who don't like financial books at all, because it reads kind of like a fiction. And it's just, people's regular stories, and they're relatable people, and they're not people that you go, I've got nothing in common, but every story might not be your story, but you might say, oh, my brother went through that, my mom, whatever, so my hope is that everyone who reads it will identify with a story or two or someone they know. And there's just some really actionable kind of, easy things to think about. And with any book that I read, if I can take away 2 or 3 things that I go and make a shift or a tweak or change and take some action on, I think it's a win.
I love it. I'm going to put the links in the show notes with the book for sure. And tell us more about how long did it take to write the book and what was the publishing process like?
So that I tend to underestimate this. That's one of my weaknesses on projects, but it was a lot. I learned a lot, and I had a great group that I was working with, and there was like these 2 kind of very different styles in the book, because we had the stories at the onset that I tend to be talk in a bit of a basic way, and so I learned a lot about what makes a story. And but I think the most shocking part about starting the book was when I started first reading some things, and I'm like, I don't know, you start thinking in terms of something being out there forever, and it's just something that I couldn't have prepared myself for until I started going, I can't put that out there like that. No, no, no. And then it can really, go down a rabbit hole trying to make it exactly what you want it to be. And then at some point it's like, you know what, I feel good about it. Got to get this done.
It's not you. It's a well-known fallacy. I think it's called the planning fallacy, where most human beings, when they start planning out a project, they think it'll be completed faster than it actually will be completed. Like, that's a well-known, well-documented bias that we have. So don't worry, it's just part of the process.
As a hobbyist, in general, yes, I experience it almost probably every couple of days. Oh, I'll just go do that real quick. That'll be about a half hour, 3 hours later.
Amy, if somebody wants to work with you, how should they prepare for your first meeting?
So for a first meeting, like an introductory meeting with me, I just like to have a conversation. There really isn't any significant preparation needed. I just like a general conversation, free flowing, get to know that person and vice versa, and see if there might be a good fit, and if I can help. There's a lot of advisors out there, and I think it's really important to work with the right one and work with someone that you trust and you feel comfortable with. And you can't be everything to everyone, and not every personality is a good fit.
In your opinion, are Americans in good shape when it comes to finances and retirement?
Absolutely not. But I think that my clients, I would say absolutely. But if we look at the stats
Right.
as a whole, a lot of people just, don't want to look at it at all. And that's probably the worst thing you can do. Even if you think you're in terrible shape, that's a great time to look at it.
One final question, Amy. What is your cost model in terms of how you charge your clients?
So I charge my clients in a couple of different ways. If we're doing financial planning is a service in and of itself. And I've got some planning packages that are on my website for different levels of planning. And then I also do investment management, and I've got a fee-based advisory model there. And with insurance, it's not really a leading piece that I do, but when I do financial planning, sometimes there will be a gap from an insurance standpoint, and if that exists, then insurance products like term life insurance, wherever those are commissionable products that are paid by the insurer to whoever writes the policy. So I just broker those out.
Interesting. All right. Where can people reach out to you?
So I think we have a special link for and I put it here. So Maven Lane Financial Group is the website, and you can put a / money seed, which is the name of your podcast. And I've got a contact link there. And if you want to schedule some time for a quick chat or an introductory call, there's a link there, and we're happy to explore if you're looking for some guidance and help.
Excellent. Yeah, that sounds great. I'll put that into the show notes. Amy Cook from Maven Lane Financial, thank you very much for joining us today.
Thank you. I really appreciate you having me on your show.
Hey, thanks for joining us for another episode of the Money Seed Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.